Good afternoon, everybody. Uneducated economist here. So it's starting to happen. The fear factor is really kicking in. People are getting out of their riskier assets and they're moving into the safe havens. They're moving into gold. They're moving into U.S. Treasuries. In fact, the entire U.S. Treasury yield curve is now under 1% except for the 30-year, at least as the making of this video. Some of that yield curve is now under 0.3. I think it's down at 0.3% interest. Can you imagine tying your money up for 1, 2, 3 years and you're going to get a 0.3% interest off of it? The only reason why investors are buying into this U.S. Treasury is because they're anticipating the Federal Reserve is going to be printing up a bunch of money and buying into the U.S. Treasuries, causing the yields to drop even further and the prices to go up. But what's not going up as far as prices go is the corporate debt, high-yielding corporate debt. Up until this point, pension funds and other investors have been scrambling to try and find higher yields, and they found it inside of that riskier junk bonds. That's the reason why they call them junk bonds, is because it's a risky purchase. But when the economy is rolling good and everybody was real happy about it, those bonds were very easy for these corporations to sell. And if it's a lot of demand for it, then the interest rate that they pay starts to drop. But the moment that turns, which has taken place now, the interest rates on these corporate debts are rising. What was the corporations doing with their money? Were they investing it back into the company with new equipment and hires and stuff? No. They took that money and they bought back their own stock, which caused the stock market to rise. So not only were these junk bonds being sold to purchase stock, they were being done by corporations that are zombie companies. These companies that would never have been able to exist if it wasn't for the fact that they were able to borrow money at incredibly low rates. Well, the time has come. It's starting to turn. I said it was going to start taking place in China first, which it has, and now it's moving into the United States. And I'll leave links down in the description for you guys. This is a very bad situation for pension funds, because pension funds have been buying these corporate debts. See, corporations that are risky end up paying higher interest rates. Just like if you had a bad credit score, you're going to pay a higher interest on your car loan or your mortgage loan than you would if you had a better interest or a better credit rating. Corporations are no different. So the riskier the corporation, the higher the yield that the bonds will pay. And corporations that do that have been buying back their own stock. Pension funds have been the facilitator of that trade. They are underfunded. They need higher yields, and they found it inside of that corporate debt. And now they're sitting in a situation in which that corporate debt is turning ugly and nobody wants it anymore. And if the credit ratings find these corporations to be less credit worthy, and they end up downgrading those corporations, those pension funds will have no other choice but to sell it off. And once they start selling those bonds, the interest rates will really start to go up, and those corporations are going to be in a very tricky situation. The only choice that they'll have is to sell their stock in order to pay back the bondholders. So you're going to see the bonds rise and the stock market drop as the credit ratings start to kick in. The downgrading of the credit ratings. I don't know what else to say about that, guys. I knew this was going to take place. I knew it. I put it out in videos many times. You know, these zombie corporations never would have existed if it wasn't for the low interest rates. And now after the Federal Reserve even went and fired off their bazooka dropping interest rates, we're finding the exact opposite has taken place and what they anticipated. The markets recognize that the emergency firing of that bazooka to drop interest rate was a bad deal. Here's the other thing. Job numbers came in looking really good. But those numbers came prior from the coronavirus running around the world. Now that the fear factor is out there and those job numbers churn, we are really going to see the market churn. It's only a matter of time. This is a bad situation. That coronavirus is not going anywhere. It's only getting worse, and I cannot imagine that the job numbers are going to continue to grow. You know, this place is a service sector. Our jobs are all service jobs. And when people stop going out to eat and they stop traveling, those service jobs are going to start getting laid off. And when they start getting laid off, they're not going to be paying their rents. And if they're not paying their rents and they're not making their mortgage payments, then the investors who have bought in real estate, they're going to get out of that trade. They're going to find that to be a toxic asset. And they'll sell it off at any point, at any price, just to get out from underneath the payment. You know, even though we see the mortgage rates dropping and people are talking about how great the housing market is, just give it the unemployment. Once the unemployment starts to rise, you're going to see a very different story taking place. You may even see the interest rates dropping at the same time real estate drops. Uneducated economist, you guys let me know.